let me welcome Professor Lekha Chakraborty. And Lekha, she's a professor at National Institute of Public Finance and Policy, and she's the elected member and of the governing body of management International Institute of Public Finance, Munich, which is the World Association for Public Finance Economists. And then she's done a lots and lots of things. Just basically, another thing which I can say is also she's done a lot of work on gender budgeting. So she's a pioneer, actually, seminal contributions in the area of gender budgeting. And I've been going through her work a lot. So, yeah. And she's also a research affiliate at the Levy Economics Institute of Bard College, New York. Okay. And so, without saying, any more now, so let me just hand over to Professor Lekha Chakraborty. And a huge welcome to you, Lekha, from all of us from UK. Yeah. Okay, over to you.
Thank you so much. Thank you, Professor Rashmi, for having me for this meeting with the students. It's my privilege to talk to your students. And you mentioned just now about the International Institute of Public Finance in Munich. We have annual meetings, annual conferences in public finance. And your students, I would love to see them there in future. This year it's in Linz, and it is in August, 10 to 12, and that's on the emerging economies public finance issues. And this is closely correlated to, your curriculum as well. And the topic is also closely correlated to that. And I hope the students over there, sending their papers, and it's a wonderful forum of, public finance economists. So, that I wanted to highlight. Now, as you mentioned, Professor Arora asked me to talk to you about the public finance, especially in the time of pandemic. And just now, prior to our talk, I was chatting with her. Then she also mentioned about the relevance of, connecting it to the monetary policy framework as well. So I will pitch my discussion today with regard to the public finance, especially in the context of emerging economies and, of course, advanced economies, and a little bit of, fiscal policy, monetary policy coordination. So the punchline these days about public finance is high fiscal deficit and high debt. That's okay. You don't have to fear public debt or fiscal deficit, and it could be a little bit worrisome, or it's a matter of concern the moment I say that the fiscal policy remains very accommodative in the time of pandemic and in the time of recession, and it's okay to have high fiscal deficit or high public debt. And now it's if in your mind the confusion started that so far in the literature we read that fiscal discipline is growth enhancing. So if fiscal discipline is growth enhancing, then we need to keep our fiscal deficit and the public debt within a threshold ratio, of to the GDP. But right now, in the time of pandemic, we have to respond with extraordinary policy responses because these are extraordinary times. That's why, if you look into the numbers, across globe, whether it's an emerging country or whether it's an advanced country, the deficit numbers or the debt numbers are huge right now. And take a look into the work by Oliver Blanchard. And you must be knowing him. He's an eminent macroeconomist. So prior to pandemic, in the American Economic Association meetings in 2019 in Atlanta, he mentioned that that's prior to pandemic, but that time also economy was in recession. That time he mentioned, I was there to present my paper, and American Economic Association or American Economic, Review. These are the forums which economists, we look forward to, engage. So students can always think about, in future, to go and present your papers in American Economic Review, Association as well. So in that AEM meetings in Atlanta in 2019, In these presidential address, he talked about the efficacy of an accommodative public policy stance. An efficacy of, accommodative public policy stance in the sense, he mentioned about very high fiscal deficit or very high public debt, and that can be substantiated if it is closely correlated with, output gap reduction, or if it can be used to enhance, the capex, the capital infrastructure investment in the context of especially an emerging economy. So you can ask me the questions related to this, but right now, let me for a moment believe that this is okay. This assumption is okay, because otherwise, fiscal discipline in the time of pandemic or in the time of economic crisis, that can be, detrimental for the economic growth process. And why we are keeping a high fiscal deficit or a high debt? Because, unless we, support the ailing economy with capex or with human capital formation, or to help the output gap reduction, then in the long term there could be severe macroeconomic consequences. And what exactly is this output gap? Output gap is a difference between your potential output and actual output. And actual output, of course, is your GDP number in the context of native economy, that is the employment, but potential, that's a controversial variable in the sense, how do you measure the potential of a country? If you are measuring the potential outcome or the output of your country using, econometric filters, by filtering out the cyclicality element in that and call that trend as the potential, then there is a controversy that, there are endpoint problems. There are many issues related to the econometric methodology, but the conceptual framework is also questioned in the sense, for a moment, we are assuming that business cycles operate in an economy. That's the way we assume to arrive at a potential output. Business cycles, in the sense, you have learned that, the cycles we date, the ups and downs we date. But dating the business cycles in the time of pandemic can be a little tricky. Or in the context of emerging economies, as Geeta Gopinath and Mark, in their work, cycle is strength. That paper, you can take a look. In that paper on cycle is strength, it was clearly mentioned that in the context of emerging economies, we cannot decipher, strict, ups and downs or strict business cycles, because, the drop in the GDP or the drop in the output you experience, it may not be cyclical, so that fiscal and monetary policy, acting as a counter-cyclical policy tool, can take it back to the prior pandemic or prior recession levels. That may not happen, because this drop in the outcome or in the output or in the GDP, that drop is a permanent scar. When there is scarring process, then you think that the fiscal and monetary policy, if they act as a counter-cyclical policy tool, you get back your prior pandemic levels or prior crisis levels of, income or your GDP. That assumption can be a little tricky. That's why, in the context of, crisis, or in the context of, pandemic, we think that hysteresis, that framework is much better than, thinking about this business cycles framework. And hysteresis is nothing but you analyze the dependence of economy on history. It's like the link between your short-term dynamics and the long-term path. So that's a hysteresis framework. Now, having said that, the analytical framework of business cycle is a little tricky. Then let's go back to the role of fiscal policy in the time of crisis. And I mentioned that high debt and high deficit is quite okay if we can substantiate that with, enhancing capital spending in the economy, which can support growth recovery process, or if we can reduce the output gap. And that output gap also I mentioned, but it is of course controversial because of that permanent scar. We need to look into the components related to the structural issues in the economy. That's exactly why in the times of pandemic, public finance decisions in terms of designing the economic stimulus packages have two components. One is like a firefighting component to tackle the cyclicality, and the other is you use this crisis as an opportunity to organize your structural reforms, because that is very important in the time of pandemic. So it has two components. Now, I mentioned about fiscal deficit as the operational parameter. But, when you look into the fiscal rules, and I will mention a little about this genesis of fiscal rules. And, in the context of European Union, when the nations came together, that economic integration happened. So what exactly holds a nation together? It's an institution. So in the context of European Union, when they decided to come together, that was on the basis of economic integration. Then monetary policy and exchange rate policy, those were exogenous, because you have a European Central Bank. But member nations have individual fiscal policy choices. But when the, this fiscal rules happened initially, what happened is that you must be knowing about the Maastricht Treaty. They talked about the threshold ratios. Like a country cannot go ahead with fiscal policy, flexibility beyond a point of, fiscal deficit to GDP at around 3%. So when, your monetary policy and exchange rate policies are exogenous, when you have to maneuver with your, individual country's fiscal policy framework, and on the top of that, if you have a threshold ratio which tells you that you cannot go beyond 3% of GDP, your fiscal deficit, then you are in a fix. If your path to that fiscal deficit to GDP ratio at 3% is through expenditure compression than tax buoyancy. Deficit means it's adjustment between your revenue and spending. So then, especially in the time of pandemic, when the revenues are not buoyant, when the taxes are not buoyant, and if a government, takes a decision that towards the that part of consolidation, towards the target of fiscal consolidation at 3% of GDP, is through expenditure compression or fiscal austerity measures, then that will have detrimental consequences in terms of economic growth, financing human development, and other social infrastructure measures. So this point I would love to highlight. That's why in the beginning I mentioned that in extraordinary times we cannot assume that a fiscal discipline is growth enhancing, because when revenue stability decides the expenditure decisions, then when revenues are not stable, then you are prone to curtail your spending. And if you go ahead with that narrative in public finance policy, then that has to happen through fiscal austerity measures, and that could be detrimental. That's why in the time of pandemic, fiscal policy remained very accommodative, and we have not done severe expenditure compression, because that could be detrimental, and we needed to operate with several components of economic stimulus package programs. And economic stimulus package programs, as I mentioned, it has two components of firefighting and the structural reforms package. And you increase the threshold ratio or revise the threshold ratio from the 3% norm, 3% to GDP norm. So in several countries, you can see that the threshold ratio of fiscal deficit to GDP is no longer 3%. And especially as I come from India, I can tell you that in our country, fiscal deficit to GDP ratio mounted up to 9% in last year. And this year we are pegging at 6%. And there is an excessive deficit procedure path. And each country has to maneuver or to design that excessive deficit procedure path. What exactly is an excessive deficit procedure? If your deficit is excess from this 3% norm, then what is your roadmap of fiscal consolidation to arrive at the prior levels of 3%? And it could be a medium-term fiscal policy framework in which you come to the 3% or even the revised norm of 4 or 4.5%, by 2025-26 or in a later period. It's not at the T period or T+1 period because it can affect the growth recovery process. So that's the quick story about the fiscal policy in isolation. Now let me link it to monetary policy. Across countries, the predominant narrative of the pandemic economics was liquidity infusion into the economy. It happened through the credit infusion or the credit deployment. And take a look into the works by Stiglitz, the Nobel laureate Stiglitz and Rashid, in their work, and that is titled Which Economic Stimulus Package Works. And in that paper, he clearly mentioned that credit related economic stimulus packages have limited multiplier effects. And if the credit related economic stimulus packages have limited multiplier effect, then your economic recovery will also be uneven if you focus too much on the credit deployment as your economic stimulus package. So what exactly we need to do here? Take a look into the credit deployment. Who access the credit? So that's a question of redistributive justice in the time of pandemic. And the predominant narrative is liquidity infusion. So when you take a look into who access the credit, then it is clearly visible that it's by the large firms, and the small firms are they are facing the survival issues, and the small firms didn't access the credit because of the fear of repayment. It's a supply side economic stimulus package that's a credit driven. And if they don't have the markets, if the demand is not properly stimulated, so that fear of repayment, from where they will repay if they engage into an economic activity using this credit deployment of the credit taken from the good lemon, from the market, from the the central bank or from the commercial banks, that is a good lemon. They are not approaching an indigenous market money lender or anything in the village to access that credit at a very exorbitantly high interest rate. It's proper. But even then, when it comes to the repayment, if you look into the statistics of repayment at an aggregate level, then poor people might have repaid, but the source of repayment may not be economic activity. They must have taken it from other sources, indigenous sources at a very high interest rate to repay that initial debt or initial credit. So it's a kind of a Ponzi finance. Then you have to ask the question whether this credit deployment or liquidity infusion as a predominant narrative of economic stimulus package is working or not. Then what are the other elements when you design a public finance package to deal with the pandemic or the economic crisis? So that components could be, more than economic growth recovery related packages, because we need to, go beyond economic growth narrative. Because if the public finance policies are going to be just focusing on growth recovery, then economic growth per se will not translate into better human development, or it cannot per se tackle the humanitarian crisis. So we need to go beyond that economic growth paradigm narrative. And we need to look into how to finance the human development in the time of pandemic. So what could be that important elements in the public finance package to deal with the pandemic? Those important components are related to social infrastructure policies, because in the time of pandemic, we experienced huge digital divide, and it was affecting the education, the learning outcomes. So we need to look into the questions related to learning loss. And what's the role of public finance over there? We need to increase the education budget, then look into education sector. That's another example for the social infrastructure policies. In the health sector, it should not be just ad hoc designing of public finance to deal with the pandemic in terms of vaccination, financing the vaccination, but use this crisis as an opportunity to strengthen the health sector by looking into the infrastructure related policies in primary, secondary and tertiary sectors. But in many countries that has not been done. And then if you look into the size of the government and the size of the health budget, these were not correlated. Size of the government means it is proxied by the expenditure, the total expenditure to GDP, and then compare it with the size of your health budget. And the hypothesis is that if the size of government is huge, then you have a predominant focus on your health sector. But empirical evidence says that the size of the government and the size of health budget are not correlated. Many countries, in which you can see that comparatively the size of the government may be less, maybe 15% of GDP, but they may have around 5 to 6% of health spending to GDP. But in countries where your size of government may be about 20% of GDP, but in those countries, if you look at health spending to GDP may be less than 1%. Excuse me. Okay, so it's not related, the size of the government and the health spending. That's why I flagged the point that use this opportunity to strengthen the health sector, because this is primarily a health crisis. So unless you invest enough in the health sector, that can mount into a macroeconomic crisis, a prolonged macroeconomic crisis. So in the times of pandemic, if the public finance is focusing on growth recovery process, without giving emphasis to the health sector, the things will be partial, the outcomes will be partial, because you need to strengthen the infrastructure in the health sector to preempt that prolonged macroeconomic crisis. So that should be the focus. Now, what are the other components? I mentioned about social infrastructure and tackling digital divide and the learning loss in education sector, and also the health sector. Then come to the other components like social protection measures. In the time of pandemic, livelihood crisis is an important issue. And what was the framework of pandemic economics? Life versus livelihood. So in that life versus livelihood, many countries, if you look into the pandemic packages, they have taken the responsiveness of the policy to life versus livelihood in a sequential manner. It was not in a simultaneous manner. In the sense, the life and livelihood issues needed to be tackled simultaneously. Otherwise, this livelihood crisis and the starvation deaths, if it's mount, and then it go beyond your control, and it may lead to civil war. It can lead to other non-economic or social crisis if you don't give enough food and fuel to the people in the time of pandemic and in the time of crisis. So that's why in many countries, social security measures were given importance, as well as food security measures. So if you look into the pandemic packages, public finance was designed not only for the growth recovery, but also to tackle the humanitarian crisis in terms of, looking into the social infrastructural policies, food security measures, and social protection measures. Now, another important component of public finance was government acting as an employer of last resort, because everything else failed. So what is that role of government to act as an ELR? ELR in the sense, employer of last resort. If your central bank is a lender of last resort, then government is an employer of last resort. So unemployment was mounting and the wages were coming down. So in that time, the role of public finance is to look into how to enhance employment, how to guarantee jobs to the people. That's why, many governments have engaged in the process of guaranteeing jobs to the people. Here the question is, what exactly should be the narrative of public finance in the time of pandemic? Whether we should be focusing on basic income or whether we should be focusing on participation income. Because that, very crucial, that foundation is crucial to design the public finance narrative. So basic income is you give, income to the hands of people. It's a universal basic income, the cash transfers or the direct benefit transfers. But participation income is you design public finance policies in such a manner that people can participate in the economy and earn an income. So in many countries, if you look into this question, whether in the time of pandemic they focused on basic income or participation income, of course it has been a judicious mix, but more or less you can see that they focused on participation income than basic income. And heterodox economics, Professor Rashmi and I studied in a heterodox school in Center for Development Studies, and heterodox school, heterodox economists always believe that employment policy is the policy to take a country out of crisis. And the participation income is very crucial to take the country out of crisis. So, given that choice, of course, a judicious mix is very important in the time of pandemic, but in long term, we do believe that, basic income that's not the long-term measure to tackle a crisis or to reach to a long-term economic growth and development, but participation income in which the government give options to the people or guarantee jobs to the people. And now there is a gender dimension to it. In the sense, if government just focuses on participation income and employer of last resort, then if you look at the access statistics that who access the credit, then you can see the gender differences over there. Because if the fastest and smartest way to develop a country is to protect the female labor force participation, then you need to focus on participation income as well as the issues related to care economy infrastructure. But usually economists, they focus on the market economy and, frame the policies based on the monetized sector. But this unpaid care economy sector, unmonetized sector, you need to focus to get the growth and economic welfare all right in the times of pandemic. But in several, public finance packages in the time of pandemic, we have seen that the targeted cash transfers were given to the women in distress. But the targeted cash transfers beyond a point may not work, and we need to guarantee jobs and we need to tackle the problems related to the care economy infrastructure as well. So that's the components of economic stimulus packages. I mentioned about growth recovery, social security measures, social infrastructure measures, including the care economy infrastructure, food security, and government acting as an employer of last resort. So these were, the major components when we unpacked the public finance decisions taken across globe. Now, come back to fiscal rules. I mentioned about the Maastricht Treaty and that 3% to GDP fiscal deficit. So let me also tell you about a golden rule in this fiscal rules framework. Golden rule in the sense, whatever you earn as revenue receipts, use that for your revenue spending. So the golden rule says that your revenue deficit needs to be zero. What is the narrative here? Whatever you borrow from the market, that will go entirely for financing the capital spending. It's not for the recurring revenue spending. There are two kinds of spending, The categorization is very important here. The revenue spending means that the recurrent spending and your committed spending like health, education, water, sanitation, salaries, pensions. But capital spending is like the long term, that capital formation that happens through the physical infrastructure in the economy. So basically, the argument that the revenue spending is bad because it's a recurrent spending and you need to focus on capex, then the story will also be partial or incomplete in the sense, in the time of pandemic, to control the deficit, to get back to the fiscal rule of 3%, if a country, if a government decides that I'm going to decrease my capex, decrease my revenue spending and protect my capex, then that decision can go wrong because the employer of last resort policies by government is very crucial. And if you decrease that, allocation related to the employment, related in that allocation, then, that can also lead to prolonged macroeconomic crisis. So we need to be very careful about the assumption that revenue spending is bad. We need to keep a golden rule, like whatever you earn through your tax, non-tax and other sources of income, you use it for financing the revenue spending, and whatever you borrow from the market, you use it for capex. That is what is a golden rule. And this golden rule is also given flexibility in the time of pandemic, because that's going to be detrimental, that if we cannot borrow if it is for the revenue spending. So that is also given little bit of flexibility. Now, I mentioned about the threshold ratio of 3% to GDP fiscal deficit. Then I talked about the revenue deficit, which needs to be zero in the time of pandemic. That also needs to be very flexible. Then third concept of deficit is primary deficit. Because primary deficit, there was a huge debate in the context of India. This fiscal management, and Professor Rashmi knows about it. We have a committee, fiscal responsibility and budget management, and in many countries you have this fiscal councils, fiscal management councils, and all, which look into this fiscal rules. And fiscal rules became very important for this fiscal discipline leading to economic recovery, that narrative. Okay, so that FRBM, the Fiscal Responsibility and Budget Management, the members of that committee got into an important deliberation that what exactly should be the operational parameter of a fiscal policy. It has to be fiscal deficit, which measures the entire net, borrowing requirement of a country, or whether it has to be primary deficit. Primary deficit is your fiscal deficit minus the past liabilities, those past interest payments. So that is the primary balance. So focus on primary balance, because interest rate is exogenous. Interest rate is not in the hands of government, and the past liability of the government, that is not in your hands. So you focus on the current fiscal policy stance and focus on primary deficit. Though that was the argument, but there was a huge dissent with this argument, and many countries even now follows fiscal deficit as the important concept of deficit to capture the net borrowing requirement of a country. Now, if you ask me whether that's okay, and to measure this gap in the resources, the fiscal deficit is the ideal measure, then I have to introduce you another concept called public sector borrowing requirement. And now IMF has already started calculating about the public sector borrowing requirement, but in many country contexts, this PSBR, that concept is absent. And in order to get a comparative perspective, we focus on, fiscal deficit. And public sector borrowing requirement is it captures the deficit at the general government level. General government in the sense, not only at the top of the national government, but the subnational governments and the deficit related to the public sector. Everything is very important. That leads to the question of budget transparency as well. In order to keep up to the fiscal rules, many countries have started, getting into a process of off-budget borrowing. Why they are going out of the fiscal deficit concept to borrow, using the public sector entities, because they have to keep the norm of 3% to GDP, because they have to show that they are credible. Budget credibility is in question otherwise, if your fiscal deficit is mounting above the fiscal rules. So this fiscal rules, that led to this innovative process of off-budget financing or off-budget borrowing to finance your spending. And many countries, you can see that fiscal deficit, if you look into, that is 3%, but a lot of borrowing that's happening outside the purview of fiscal deficit, and that led to the questions related to budget credibility. And what exactly is budget credibility? What you keep in terms of the fiscal rule, that is a 3% of GDP fiscal deficit norm. Then what you announce the budget, that is your estimates, or what you project in the budget as estimates for tax predictions and all. And when you look into the actual numbers after 1 year, there should not be any deviation. If there is any deviation, that means you have fiscal forecasting errors. Then your budget credibility is in question. In order to minimize the fiscal forecasting errors, you need to keep that estimate and the actual to be very close. And otherwise, it is leading to fiscal rules. And that's a question, especially very crucial in the time of pandemic. In many countries, this analysis of budget credibility is done using a technique called fiscal marksmanship. So when your marksmanship is perfect, Your marksmanship is perfect only when the fiscal forecasting errors are minimized. That means what you announce in the budget and what is real, this should be very close, and if there should not be any errors. And you can also trichotomize or dichotomize the sources of errors. Has it happened due to random factors, or has it happened due to the bias of the policymaker or variation? So these questions you can technically ask. And there's a paper in an IPFP where I work. We looked into the fiscal marksmanship analysis, because that leads to the analysis of the fiscal risk as well. And in many countries it is identified that tax projections and the tax realized, that fiscal forecasting error is so huge. Why? The assumptions and the models used for tax projections, that needs a revision. Otherwise, you cannot expect what you project in your tax, projections. So that is one thing. A second important element is intergovernmental fiscal transfers. When we talk about public finance, it's not only about the expenditure and revenue accrued to a government, that is owned revenue. The source of the government's revenue can be, along with the owned revenue, it can also be the intergovernmental fiscal transfers. Why that's the case? Because if you look into the public finance, that federalism, fiscal federalism, the assignment of expenditure and assignment of revenue, if you look into, there's a huge asymmetry. Like many buoyant and dynamic taxes are at the top level of government, but the expenditure assignment or the functional assignment, the crucial functional assignments are at the subnational governments. So how do you tackle that? Because if your functions are, at the subnational governments, and if your revenues are at the top level, you need to devolve funds to the subnational governments. In the fiscal federalism setup, in that cooperative federalism setup, you need to do a fiscal transfer, and that's a big source of, revenue to the subnational governments. And how do you transfer money? You can transfer money using conditional transfers that is tied to a specific purpose. Like if you're asking the government to tackle the education related issues, then you do an education equalization transfer. If you have to tackle with the health equalization issues, then you transfer a health related transfer. That is all conditional. Why it is conditional? It is tied for a specific purpose. But in many countries, in addition to this specialized or equalization transfers which are conditional in nature, we have unconditional transfers. And how these unconditional transfers are designed? It is designed on the basis of a scientific formula based on the population, area, socio-economic backwardness of the subnational governments. You design a transfer to the lower levels of government. And in many countries, population is a crucial factor. They look into to divide or to devolve this money to the lower levels of government. And area, that's a big concern. You can ask me a question. If the primary purpose of the fiscal transfers is to offset this fiscal disabilities across jurisdictions, then why are you getting into indicators related to socio-economic backwardness? Because in many countries, the narrative of public finance has gone beyond offsetting fiscal disabilities across jurisdictions. Now, the frontiers of public finance has been enhanced, and it's a predominant role for a fiscal policy maker to look into even the climate change related issues. So this is like a very new thought process, like how to tackle the climate change crisis. In the process, there is a tug of war between the monetary policy and fiscal policy. Monetary policy makers, it's a huge debate. You can take a look into the Journal of Monetary Economics. There's an article by Hansen. And Hansen mentioned that if the central bank is getting into the issues related to climate change, that can lead to reputation risk, because you are going to divide green bonds and brown bonds, that investment decisions, then it can be a political question. And the political economy can be best tackled by fiscal policymakers. So climate change needs to be the cup of tea of fiscal policymakers. Then it is closely related to how you use your public finance field to design the ecological fiscal transfers, and also how do you design a climate responsive budgeting. So these are crucial tools, public financial management tools, to look into the questions of climate change commitments. And even Rekuram Rajan, he's a monetary economist, and Rekuram Rajan's thought process, he's from Chicago School, you must be knowing him. And he also mentioned that it can be a little political if central bank gets into this climate change commitments decisions. It has to be on the side of fiscal policymakers, because the predominant role of a monetary policy or a central bank is price stability, inflation containment. And if you get into many conflicting priorities for a central bank, then that can lead to reputation risk. So this was his argument. So these are crucial questions in the time of crisis, like how do you look into the climate change crisis, how do you look into the humanitarian crisis. And humanitarian crisis, I mentioned to you about the various components of the package. That's very crucial, and I mentioned about this basic income cannot go on and on to support the pandemic times. And now let's get into the fiscal monetary policy coordination. So if price stability is the predominant narrative of central banks across the world, then in the time of pandemic, how they can support the growth recovery process. And in many countries, there was a rethinking in the basic objective function of central bank, and growth first narrative was embraced by many central banks. Prior to the price stability, we need to focus on growth stability. You know why? It is a conflicting thing. There's a policy dilemma over this, because the predominant tool of a central bank is interest rate. And in the time of pandemic, if you're focusing on growth recovery process, you need to keep interest rate lower. And Professor Arora worked in she's a central banker, so she knows in detail. And I think that she must have already spoken to you about this monetary policy narrative. So let me take a quick look into it. And you need to keep the interest rate lower for the growth recovery process. Now, energy price volatility is mounting. The war in Ukraine, that led to many supply chain disruptions. The consignments are getting delayed, and there are huge exogenous supply side shocks. And we need to tackle this global inflation, or this mounting inflation globally. So if you keep the interest rate lower, you will be in a very tricky position to respond to this. But if you hike your interest rate, then that affects the growth recovery process, because you need to keep the interest rate lower for investment to be triggered, for the credit to be offtake to happen, and then that lead to growth recovery process. But at the same time, if you keep the interest rate lower, that affects the financialization of savings. If you keep the interest rate lower, and that can also lead to the question of negative interest rates. Like if the nominal anchor of inflation in a country is, suppose for example 4%, and if the inflation is mounting up to 7%, then the real interest rate is your nominal interest rate minus inflation. So it's like 4 minus 7. That's getting into the negative interest rate quadrant. And what are the policy implications or the repercussions on the economy from this negative interest rate? Because you don't get even the money you deposited in the bank, right? If it is you are in the negative interest rate quadrant, then you don't get even the money you deposited in the pension market. So the financialization of savings was getting affected, and people started moving out, taking out their savings from the financial sector to real estate, or even the equity markets or the stock markets, or even the high return, high risk assets. A small segment of people were trying that. So this affects poor people, because poor people mostly depend on the banking sector for the financialization of their savings. So this negative interest rate or the zero bound interest rate, these are matters of concern. And zero bound interest rate, then you cannot trigger your economy. You have reached a liquidity trap. So these are questions when you look into interest rate as a predominant policy tool for growth recovery process. You need to ask a question, is it one to one? Then another important question, when Professor Aurora was a central banker, when she was with the central bank, that time this inflation targeting framework was not that predominant. Monetary policy function was very comprehensive. But of late, later, many countries have taken up inflation targeting as an important rules-based monetary policy framework. And if this new monetary policy framework, whether it is effective in the time of pandemic, we need to ask. In the sense, this inflation targeting is supposed to anchor the inflationary expectations. And from the supply side exogenous shocks, exogenous supply side shocks, will this interest rate inflation targeting can anchor that inflationary expectations? These are questions we need to ask empirically. And if we fail to anchor the inflationary expectations, then the efficacy of inflation targeting itself is in question. And what exactly is inflation targeting? You peg your policy rates based on this nominal inflation, inflationary expectations. Of course, that inflationary expectations is an unobserved variable, and you need to float expectation survey to capture the inflationary expectations. And based on the output gap I mentioned towards the beginning of lecture, I mentioned in the beginning about the output gap. So output gap, inflationary expectations, and inflation angle, these are crucial determinants to arrive at an inflation targeting framework to peg your policy rates. And here the question you need to ask is the efficacy of inflation targeting, whether it is able to anchor your inflationary expectations in the time of pandemic. Otherwise, what? If consecutively 3 quarters, if the inflation go beyond your nominal anchor or within the band, then you are, above your comfort zone of inflation. Then, if you keep the growth first narrative, then it can affect, your economy by hurting, this sentiments, market sentiments, because your inflation is mounting. And how globally, central bankers responded to this. Bank of England, even the US Fed Reserve, a lot of banks have increased their interest rate, which they kept the interest rate lower for a long time because the economy was passing through this pandemic. It was a pandemic-ridden economy, but with this mounting inflation due to this global uncertainties, energy price volatility, many world nations, if you look at the central bank's responsiveness, you can see that they have started increasing the rates of interest. And RBI also, RBI means Reserve Bank of India in India. We also have increased the interest rates very recently. And Bank of England, they have looked into even the stress test, green stress test, in the sense they ask the questions to the investors, have you looked into the stress factors related to the climate change commitments, because that can in turn affect your financial stability. So that's exactly the debate. Like, we don't have toolkits to look into climate change commitments because our predominant narrative for a central bank is price stability and financial stability. If you are taking that stance, then climate related or climate change related risk and uncertainties can also affect your financial stability, right? So you need to look into the climate change related risk and uncertainties. And Bank of England has gone ahead with stress tests. They have increased the interest rate to tackle the the mounting inflation. Then European Central Bank, Christine Lagarde, she also announced about greening of monetary policy. And globally, let's look into the Fed Reserve. I know that Professor Arora, I have spoken to you about what is happening in the Fed Reserve. It's a kind of taper tantrum which affects the fragile economy. They have decided to decrease the balance sheet, and that inevitably will lead to a series of increase in the Fed reserve rate. That will affect the emerging economies in the sense. In the emerging economies, a component of the foreign capital is hot. And hot money, by definition, that financial element that respond to the high interest rates. So if there is an interest rate differential, the hot money responds to the countries where your interest rate is high. So in order to avoid the capital flight, the emerging countries also need to increase the interest rate. But the conflicting priority here is, if you keep on increasing the interest rate to tackle this capital flight, mounting inflation, how do you tackle with the growth recovery process? Because for the growth recovery to happen, we need to provide cheap credit. Investment and interest rates are inversely related. So it has to be, and there's always a tug of war between monetary policy maker and the fiscal policy maker, because fiscal policy makers always, prefer to keep the interest rate by the central bank to be low because of the public debt management, which I mentioned earlier. If you have high fiscal deficit, high debt, in the time of pandemic, the narrative I mentioned that don't fear deficit. So our public debt management will go haywire if the interest rate starts mounting. Public debt management will be tricky. So in that context, many countries invented another way to tackle this crisis related to the structure of bond markets. In the sense, you look into the structure of maturity or the maturity structure of the bond markets, and you can do a little bit of maneuvering over there, like simultaneously buy a lot of long-term securities and sell a lot of short-term securities. We call it as kind of an operation switch or twist or something like that. Why we are doing that? In order to do an elongation of maturity structure of the bond market, because the public debt is predominantly financed through the bonds. That's a question of the financing of debt and deficit. Because so far I was talking to you about the levels of fiscal deficit, but the financing of the fiscal deficit or the public debt is equally a matter of concern when we talk about public finance. So what are the predominant ways to finance your deficit? One, senorage financing, like you print money from the central bank and finance your deficit, and that's going to be inflationary. So many countries have controlled monetization of deficit. This is monetization. You print money through the ad hoc treasury bills. You can control your you can finance your deficit, but that part is controlled because that was inflationary in nature. And now, what is other predominant way to finance a deficit? Through bond financing. Like you have a laudable funds pool in the market, so you preempt that laudable funds to finance the deficit. Then what could be the consequence? If you preempt a lot of funds to finance deficit, what is available, the laudable funds available for the private corporate sector may be dwindling, coming down. So that can lead to increase in the interest rate theoretically. We call this phenomenon as crowding out. But in the context of emerging economies, increasingly it's getting realized that bond financing of deficit will not lead to crowding out of private corporate investment if that preemption of the laudable funds beyond that high fiscal deficit, if that preemption of laudable funds is used for enhancing the capex, the infrastructure investment in the country, then it will crowd in rather than crowd out private corporate investment. So that's a narrative. And even this shift from the senorage financing of deficit to bond financing of deficit was predominantly for controlling inflationary pressures. But literature says that, beyond a point, even bond financing can be inflationary. So even if you shift from senorage financing to bond financing, that inflationary pressures cannot be tackled perfectly. You know why? There is a condition called R greater than G. R is the real rate of interest and G is the real growth of economy. And if the real rate of interest goes beyond the real growth of economy, then you are not growing out of your debt, right? Growing out of debt means you may have high fiscal deficit or high debt, but if it is growth enhancing in nature, then it's okay. But the moment R is greater than G, then the cost of credit is greater than the rate of growth of your economy, then your debt is no longer sustainable. You are getting into trouble. So when such situation arises, then you have to eventually monetize the deficit by going back to our central bank we need their help to finance the deficit. So then, inflation today is inflation tomorrow. That's the only policy flexibility. If you get into a situation of R greater than G, you're getting my point. That's why I mentioned that inflation today or inflation tomorrow is the only flexibility in the fiscal dominance literature, because if R is greater than G, there is an eventual monetization of deficit. Now, what could be the third important way to finance your deficit? That is getting into external financing. And you know that what has happened in Sri Lanka, they have a lot of external financing of deficit, that can be little detrimental. And in many country contexts, the donor presence, you take money, the foreign aid, the money from multilateral agencies, that can be little tricky because it affects the macroeconomic stabilization, especially in the time of crisis and all. If you take, prolonged borrowing from abroad, then that financial oligarchy takes a call on your decisions, the individual countries' public finance decisions. So will you be able to tackle that? That exactly was the question asked in terms of, Greece, in the context of that European Union, because Greece asked that question, like that financial oligarchy, the European Central Bank and the IMF, many countries are, deciding the functions of the public finance in the context of our country. Then, we have to keep the fiscal discipline intact, but then where is the money to, to use for pensions, for employer of last resort policies, for many developmental functions to improve the growth process of a country? So these are the questions asked. But people do innovate, countries do innovate how to do this. And one innovation is that off budget. Second innovation is elongation of maturity structure of the bond markets by keeping off your refinancing risk to future. So if you have more long term, then your refinancing risk is postponed to future. So that's the way you can cleanse, or you can tackle with the maturity structure of the bond market, because a robust growth path is very crucial to recover from the pandemic. To keep the robust growth path, you need to postpone your refinancing and get into getting your maturity structure by by lot of long term and not into the short term. So these are the different ways in which you do the process of financing the deficit. Now, in the time of pandemic, the question is, where is the money? Fiscal space. Where is the fiscal space to deal with the pandemic? So you have to reinvent the fiscal space. And when you have fiscal rules, you cannot go beyond a point to enhance the fiscal space. But right now, two important decisions are taken. One is you keep the fiscal rules as a contingent fiscal rules, but don't use it. If you fear a bad equilibrium, you keep it, but don't use it in the time of pandemic. So that's an important decision, to keep the fiscal policy stance accommodative in the time of pandemic. Then second, what is your process to tackle with the excessive debt procedure part? Because otherwise, budget credibility will be questioned if the fiscal forecasting errors are there in future. And third point is fiscal and monetary policy coordination. And even many governments are thinking about, this zero rate financing, the monetization of deficit now. And you can read that IMF blog. Recently, they have talked about why this monetization of deficit is a taboo in the time of pandemic, because where is the money can be a cruel question. If you reach to that point, even think about monetization of deficit. Otherwise, you will not have enough fiscal space to deal with the pandemic. And these are quick points I thought that I will speak to you. And one final point, because I noted down the points I would love to talk to you. And one final point is, economic stimulus packages are short-term in nature. Then we have to focus on long-term public financial management tools to tackle the growth and development questions. So that's very important, because these are short-term. Any time normalization procedure will happen, earlier than expected normalization procedure has started now. What is normalization procedure? We have to bring back the deficit to earlier levels. We have to keep the interest rate high. So these are the important components of normalization procedure. So if such things happen, you need to get back to, a long-term public financial management tools to tackle the crisis. Thank you. Over to you, Professor Arora. Thank you so much. We can take questions.
Thank you. Thank you so much, Lekha. Very interesting. And and some of these points we have talked about it. Actually, they did one assignment question on should monetary policy be considering, taking into account inequality and climate change. So they did that assignment question as well. So many of these, thank you so much, and very interesting talk. Now I'm opening, the floor is open for questions, so you can simply unmute yourself and speak, or you can write in the chat as well. I think Cynthia was asking how many sectors are there. Cynthia, do you want to unmute yourself and speak? Your question was not very clear to me. So if you can unmute yourself and ask. And also some of our staff members are also there. So I welcome everybody to, the floor is open for everyone. Yeah, Cynthia? Okay. Yeah, so I'm not sure whether Cynthia is able to hear me or not. But any questions, please? Yes, Cole, go ahead.
Hi. I thought it was an interesting point you made about the reputation risk that central banks can have by getting involved with, or being seen to get involved with climate change. Do you think that because when I was looking into this for the assignment question, I think that there's an argument that's being made that essentially there's a reputation risk as well for them not being involved. I know there's mandates for central banks to be seen as independent and apolitical and to focus primarily on price stability. But in the research that I did, I saw that climate change can actually hamper the transition mechanisms of monetary policy. And so do you think there's also a reputational risk of them not addressing such? Thanks.
Oh, Griffin asked that question, right?
Yes, yeah, that's me. Yeah.
Thank you so much for your observation. And I would love to know your take on this. Should we do that or not, the central banks? But my personal take, I would love to hear Professor Arora's point as well. But my personal take is lack of toolkit cannot be a predominant, a reason for not looking into the questions related to climate change. And second is, of course, by mandate, many central banks were asked to look into the price stability and financial stability alone. But as I mentioned earlier also, the climate change related risk and uncertainties can get into the financial instability. So, that climate bonds, this is one of the important ways in which, many countries are entering into the policy field to tackle the, this climate change related risk and climate bond initiative. That's quite important because otherwise the financing of fiscal deficit, we have never thought about a very thematic kind of financing deficit, that you are earmarking a portion of financing of deficit through bonds to climate change commitments. So, but earmarking can lead to the questions related to other redistributive justice as well, because you can get into the gender bonds to look into the questions of gender inequality. You can get into many things. But countries have started checking out that thematic bond financing, earmarking the bonds to a specific purpose. But then, the decision is you finance it through the internal bond markets or external. if it is external, then a lot of repercussions can happen. Because there are different kinds of bonds available. One is your currency denominated bond. Second is dollar denominated bond. So the interest rate differentials and the exchange rate differentials can affect those decisions. So you need to go ahead with the sovereign bonds in the external market or internal market is an important question. But I do go with the point that monetary policy has got a role to play. We cannot say that we will get into little political economic questions the moment we distinguish between brown bonds and the green bonds, because we can always do just like the Bank of England. They were the first to go ahead with the stress test. Those kind of greening of monetary policy, I think we should be looking into, rather than confining to fiscal policy space, ecological fiscal transfers, or climate responsive budgeting. I think it has to be coming from the monetary policy as well. Yeah.
Yeah. No, I do agree. Yeah.
Thank you, Cole. Yeah. Questions? Just unmute yourself, or comments, or any observations. Just simply unmute yourself, or you can write in the chat as well. Yeah, I think people are. There are so many things, yeah, which we discussed. So
yeah, it was like a transition from the discretionary space of a policymaker to rules-based. And I don't know, students are comfortable with that transition in the sense fiscal policy is like it's rules-based. Like we have fiscal rules 3%. Monetary policy is also again rules-based based on inflation targeting. So I was personally getting uncomfortable with that transition because if from the discretion to rules, especially in the time of pandemic, this rules-based macro policy framework can be little difficult, especially to deal with the questions related to pandemic. And that's what we are facing right now, because we are thinking about that fiscal rules, that 3%. Then we may not even enter into the policy decisions which are very required for economic growth recovery process. So maybe I would love to know their point of view regarding this rules-based framework. Are you comfortable?
Yeah, I think you're right. But so this actually COVID came on top of the previous global financial crisis, actually, isn't it? So the countries were still recovering from that, and that's why we have this negative. We went into the territory of very low interest rates or negative interest rates or something. So so that had been going on, and then came the COVID, and now we have another aspect to it, which is with the Ukraine war currently going on. So so we are dealing with both demand as well as supply issues, and COVID was like how I organized my thoughts. Like COVID was more for the growth where we were targeting, and now the Ukraine war is actually the more of inflation. So inflation versus growth. So these two, this dilemma is actually going on, and so we have discussed about the monetary and fiscal policy conflict going on. And actually, Bank of England, we had one seminar with the Bank of England as well on inflation. And the speaker they said that the objectives are very different. The government's objectives are different, and the monetary policy objectives are different. And that's why there is no conflict, but it's just because that they have different objectives to follow. So so it's very interesting.
Hello, Prof.
Hello, Ramesh.
Hello.
Yes.
Ishak.
Ishak, just hold on 1 minute. I think Ramesh had raised his hand. Ramesh, Ishak, I'll just come to you. Ramesh, would you like to speak?
Yeah. Thank you, Professor. Good morning, Professor Lekha. So thank you very much. It was actually a power-packed presentation, I must say. Like, in 1 hour, you have given us so much. I think we need to do a lot of, study after this to understand the many terms that you have used in this, and it's really interesting. So one thing, I have 3 things, in this. One thing is you spoke about the size of the government. Probably if you can elaborate a bit on that, that's something would be interested to know. The other thing is about the golden rule that you have spoken about. Especially I come from India, so where I am seeing that after COVID, many state governments they are getting into this kind of providing cash benefits to the people. They are not spending, there is no evidence of any creation of physical infrastructure and jobs, but the debts that the states are incurring, they are spending the money on public benefits, giving cash benefits and all. So which I think in the long run is going to be detrimental for the overall economy. But at the same time, we can't ignore the fact that many people were actually, downtrodden, who are in the bottom of the pyramid. They were actually, they lost their jobs, so they need some assistance. So how can governments balance this kind of an situation? So I would like to know your views on that. Then thirdly, if you look at India, after this COVID, many neighboring countries of India are actually getting into fragile situation. So what happens to a country like India when the neighbors are getting into that kind of a fragility? So how do we handle this? So these are various things. If you can just throw some light on that, that would really help. Thank you.
Thank you so much. Professor Arora, I take Ramesh's question before, or somebody else raised the hand. So should I listen to her question?
Yeah, that's fine. Ishaq, would you like to just unmute yourself and speak?
Yes, ma.
Yes.
Good morning.
Yeah, good morning. Go ahead.
Sorry, I catch up with the program lately. I thought it's by 11. Based on this, climatic change, Prof, and the role monetary policy plays, to me, I view this thing, monetary policy issues, most especially the case with Nigeria, as more of political. Because based the climatic change, what role does monetary policy play in helping this microeconomic unit that have faced downfall in terms of climatic change? So to me, is there an active role that this monetary policy plays in terms of aiding microeconomic? Because I view it like the most concerned with the macro level, like demand and supply and other things. So is there any impacts on that on microeconomics specifically?
Okay, thank you. That is Ishan's question, huh? Something is there in the chat box. Cynthia.
Yeah.
Okay.
Cynthia, yeah, I think, I don't know whether Cynthia is able to hear us. Cynthia had raised this question, how many sectors are there? So her question was not very clear to me. So, yeah, but yeah, Cynthia, you are very welcome to just unmute yourself and speak.
Supplement the points to her point. Yeah. Thank you so much, Ramesh, for, those points. Thank you so much. And your concern about our neighboring countries, there are many emerging economies of the island economy, especially we are talking about Sri Lanka. If you look at the history of Sri Lanka, over the years, if you look at the public debt to GDP in Sri Lanka, it was above 100%, but they lived with that because, debt sustainability was never an issue in relation to this R&G issues and all. And human capital formation was quite good in Sri Lanka. Excuse me. But right now, a lot of external commercial borrowings has happened. Like as I mentioned earlier, the financing of deficit in Sri Lanka was external. Excuse me. And the use of fiscal space, as you rightly mentioned, they have designed more of, giving freebies, giving those, the use of fiscal space was little, giving short-term benefits like triggering or incentivizing the calculus of consent of people and, to incentivize the voting pattern. It was in terms of not a long-term capital investment at all. It was short-term. So when it got combined with this external financing mounting beyond a point and the use of fiscal space was predominantly for the short run or the calculus of consent, those kind of policies, they ran into trouble. And also we have to understand we can distinguish between a very diverse and very robust economy like India and a small economy, island economy like Sri Lanka. So as I don't know, you have fears whether it will happen to India, but I think it will not happen to the major diverse emerging countries context. But that country context, the volatility from the external sector through the terms of trade and the volatility from the financing pattern of deficit. So all these things affected that economy. And beyond a point when there is no food, there is no fuel, then that can lead to, a social unrest. So that's exactly what's happening. And now there is a fund flow in terms of supporting the economy. And we need to wait and see what's going to get happen. But I don't think that that situation will arise in the context of India, basically, or any other emerging countries which is little diverse, where we are not prone to the volatility coming from the terms of trade and the volatility that's coming from the external financing of deficit. So these are important points. Now, your question related to the size of the government, size of government is basically proxied by the expenditure, the total expenditure to GDP, and what determines that expenditure decisions. And there are many theories behind that what determines your public expenditure decisions. And, it's a variety of literature. One is mechanism design, the public goods theories, then even the voting models. The democracy can determine the size of the government, and even the globalization determines size of government. So it's a kind of a very rich literature which talks about what determines the size of the government. And quickly, quickly I can take up this mechanism design, and also the question asked from the microeconomics point of view. If there is incentive compatibility between what government provides and what people, citizens expect from the government, and if your budget is balanced, and if that leads to a Pareto optimality condition. So there are three conditions I mentioned: Pareto optimality, incentive compatibility, and a balanced budget. So this should be an ideal mechanism design when we think about financing public goods especially. But the Nobel-winning literature by Hurwitz in 2011, I think, Eric Maskin and all, they increasingly prove that through the algorithms and all, these three conditions are not simultaneously possible. Because incentive compatibility, you can understand that in many country contexts, including in India, there's a rich vocabulary of tax evasion and people are not willing to pay taxes, basically because there is no incentive compatibility or there is no Wickselian connections. That's the way we call it theoretically. Wickselian connection in the sense, Lintel-Wicksell mechanisms talks about a connection between the people, the tax paid by the people, and the utility derived from the government's programs. And if this link breaks, you get into this rich vocabulary of tax evasion. People don't pay taxes, but in the Scandinavian countries and all, people are willingly pay high rates of taxes because there is a Wickselian link. So the empirical evidence shows that the Wickselian link breaks. So if you are, keeping the size of the government based on the stability of revenue, then you need to ask the question whether revenues are stable and what are the leakages over there, whether the people are willing to pay taxes. So one way in which this issue is tackled is through atomized taxes, and that is also another theory. Atomized taxes in the sense, Ramesh and me will not pay equal tax. In the sense, if Ramesh reveals his preferences that the utility he is going to derive from a public good is more for him, then the government takes more tax from him. But I reveal that no, this utility of mine will be little less. So then I pay little taxes. So this atomized taxes leads to a convergence in the sense, in the long term, Ramesh will decrease his utility or consumption from that because of the high rates of taxes, and I increase the utility, and the convergence is reached. So this is a way in which mathematically through algorithms and all, people work out these issues about the government, economics of government. But in practice, in empirical evidence shows that, there are a lot of issues related to this, and we need to understand the revealed preference is strategic or sincere. Because when it comes to the financing of the public good, if the revealed preference is strategic than sincere, then that's a very important question regarding how you can finance your deficit or how can finance your expenditure or the economics of government. This is one thing. And people have tried to solve these issues theoretically, and mechanism design, those kind of literature you can read to understand the size of the government debate and how that's the microeconomics level. Now, I mentioned about the calculus of consent. Democracy determines public expenditure or the size of the government. But if you look into the voting models, you can understand the William Ricker and the Anthony Downs, that book, the economics of government, or that calculus of consent by Buchanan. If you get into the public choice literature, you understand that there are many factors determines the size of the government, not only the economic factors. Like, why do you vote? If I ask that question, why do you vote? It can happen because you vote because the probability of your candidate winning the election and the benefit you derive from the voting will be so crucial for you, because you, in retrospect, you voted back the government in power because the government was doing so good. So that can happen. Then it's a sense of civic or that civic responsibility, the duty. Because of that also you can vote. But if the cost to voting is greater than the benefits you derive from the voting, then people don't vote. So that in retrospect, people voting the government back to power, that also designs the economics of government. That's why many countries, get into this short term, as you rightly mentioned, Ramesh, that they get into designing some public expenditure decisions, which is, incentivizing the calculus of consent narrative. So that can be a little tricky, and it can, of course, as you mentioned, it can be, very unsustainable in the long term, and we have started seeing it across globe. So the capital formation, that focus on the capital formation is very crucial, giving that judicious mix of cash transfers, targeted cash transfers, just to overcome the pandemic concern. So now you asked about the question, golden rule. I noted down golden rule. And, there has been a fundamental rethinking about this golden rule in the fiscal policy. And, all these narratives came from, IMF, Peter Heller, Bladger, they came up with a survey of the different concepts of deficit and the financing pattern of deficit in the early 90s. And based on those, we have moved away from a single concept of deficit to multiple concepts of deficit. And after that, the fiscal rules started coming up, thinking that the fiscal, discipline is growth enhancing. So in that literature, this golden principle was basically to control the fiscal profligacy of the government. In the sense, whatever you earn, use that particularly for covering the recurrent spending, but nothing more than that. But using several fiscal clauses and amendments to the legal side of the fiscal rules, many countries have amended that golden principle of phasing out revenue deficit. Because you have two components to a budget. One is a revenue budget, other is capital budget. So that revenue budget means that you talk about the revenue spending and revenue receipts, and these have to be equal, and that's the golden rule. Then whatever you borrow will exactly go for the capital budget or the capital infrastructure spending. But that golden rule is getting attacked, quite a bit. And now many countries have taken that away from their fiscal rules framework. And I hope that I have answered all the questions Ramesh asked. Yeah?
Yes, thank you so much for that.
Okay, I have answered. Okay, thank you, Ramesh. Now the questions asked by Ishan, and that is closely related to the questions asked by Cole as well, and it was partially answered, but the questions related to that micro responses, because there was a little bit disturbance. So if I understood clearly, in the environmental federalism, principle of subsidiarity is very crucial. Principle of subsidiarity in the sense, the government which is closest to the people, they can take many important decisions. That is, we call it as fiscal decentralization, and including the climate change commitments. So when we give emphasis to the principle of subsidiarity, then the climate change narrative, that becomes the prime responsibility of a subnational government. And then the intergovernmental fiscal transfer mechanism, by incorporating one criterion on climate change, can be very useful, in the sense, in the fiscal side, I mentioned that the intergovernmental fiscal transfers are very important to tackle, the redistributive justice question and climate change. So if you can incorporate one criterion related to climate change and devolve the funds down to the subnational governments based on the principle of subsidiarity in a fiscally decentralized framework, then the lower governments can address to the climate change concerns very well. Now, I can understand Ishan's concern. Ishan, I think, isn't it? Ishan or Nishan? Ishan. Ishan's concerned about the international public goods. So if you are looking into the question of climate change as an international public good, then we have to go beyond that. And there is a wonderful paper by Will Oates. He looked into the question of this environmental federalism, and he trichotomized the three important components of the climate change commitments. One is the climate change as an international public good. Second is the climate change we need to look into from the perspective of inter-jurisdictional spillovers, because it's not a localized question. Then third is completely a localized public good. We need to answer questions related to the localized thing. So Ishan's question related to the international public good perspective, then monetary and fiscal policy both has got a predominant role to play. Of course, this interjurisdictional spillovers, I think two member nations or two countries or even two jurisdictions within a country can deal with that matter through tax transfers or without government, Pigouvian transfers we call. There are many mechanisms to deal with the interjurisdictional spillovers like air pollution or whatever, elements which involves two jurisdictions. Then the localized thing, a government at the lowest level, that fiscal decentralization can tackle. But when we think about climate change as an international public good, then that coordination between fiscal and monetary policy is very crucial. There, we need to identify the toolkits by the central bank to deal with the issue, rather than focusing on, just price stability as the comprehensive function of the monetary policy maker. Professor Arora, you would love to add some points to this, because I think Ishan's concerns were more related to the questions on monetary policy side. Yeah.
I think, you have covered, Lekha, quite a lot about it. So I would just, whatever. I agree with you fully. Yeah. I think Jonathan has raised his hand. Jonathan, would you like to unmute yourself and speak?
Hi, good morning to everyone.
Good
The
morning.
question I want to ask with reference to public finance, especially when there are these huge shocks like pandemics and things of that nature, what role does fintech play in terms of assisting those that are greatly affected by those disruptions? And I know that it is, some of the research points to it as a disruptive technology, but do you think that it can be incorporated and used to facilitate or to bridge the gap, leading towards financial inclusion and ensuring that everyone can benefit from the different stimulation packages that governments may be offering? So that's my question pretty much.
Good. Thank you, Jonathan, for asking that question. I missed this point about financial inclusion. and this disruptive technology. So let me take a minute to speak to you about the CBDC. I know that Professor Arora must have already spoken to you about that, CBDC, central bank digital currency. But in the context of pandemic, the digital infrastructure helped to ease the concerns of people. But in many countries, emerging country context, there is huge digital divide. So if there is huge digital divide, then digital infrastructure can ease your concerns and lead to financial inclusion. That may not happen. So we need to tackle the digital divide first. But once we tackle that, this digital currency as a medium of exchange or a store value, whether that can be very helpful in these extraordinary times, that's a very important question. And as you said, this financial inclusion from that perspective, even the Treasury Secretary Janet Yellen, that I read in a work by Barry Aiken-Green, his paper was related to dollarization, the digital dollar. So there, he mentioned about the perspective of Janet Yellen in going for digitization of currency or digital currency as a legal tender, digital legal tender, to work out this financial inclusion perspectives, because many parts of US and many parts of emerging economies are highly unbanked. When your country is highly unbanked, when you don't have enough bank branches, the penetration of bank branches in many regions, then how do you go ahead with financial inclusion? In such cases, digital infrastructure and legal tender, digital legal tender can be very helpful. So that was her argument. But this can happen only when your digital divide is tackled. Otherwise, when the world stopped, whatever digital infrastructure we had, that helped us quite a bit in terms of e-commerce, or in terms of education, in terms of financial inclusion. Everything helped, because when world stopped, that was the only technological space which was available to us. So that I take it as positive. Another important thing mentioned by Janet Yellen was in the time of pandemic, the fiscal policy and monetary policy coordination in her government in US was in the form of huge cash transfers. So how to get this pandemic checks to reach the people? There also, if that digitized legal tender was there, that can ease the way the money getting into the hands of people. So that was another point which was highlighted by Barry Aiken-Green citing Janet Yellen. But you need to have a regulatory framework on board the moment we think about this new technologies and the new skills, or the new normal, how to tackle the new normal using the technological space. Their regulatory mechanism is very crucial. And we also heard about the crypto, the new kind of currencies in the market, which is highly speculative asset. Of course, it's not a legalized tender. It is a speculative asset. But if in the times of pandemic or in the extraordinary times, if it can lead to smoothening of cross-border transactions, of course, based on the models of trust and based on the models of financial integrity, I think there is a role of government to support those kind of digital transactions, the cross-border transactions in the form of crypto, because otherwise, we get into a lot of issues related to, fraudulence and all. But instead of banning those kind of new, evolution in the field of money and finance, so I take it as that evolution in the field of money and finance, rather than banning it, we need to support that with proper regulations, because saying no to a technology or saying no to a financial innovation, that's not okay when I think about it, because central banks are increasingly getting scared because it will affect the financial stability. But banning is not a solution. That high risk, high return is a small group, because it's not a very broad-based, sector at all. It's a small group. So how we can, help them using the regulatory framework, we need to look into. These were the quick thoughts. I think there was a disturbance when he asked me the question, but I think I got the crux of his question. And if you have any supplementary questions, Jonathan, you can ask me.
Actually, you covered it well. I just want to ask, what are your views on regulatory sandboxes with reference to fintech?
What is my stand on regulatory framework versus
regulatory sandboxes.
Regulatory sandbox. Yeah, we just recently we did this in the class as well. So.
Oh, thank you so much. My limited, view. I think Professor Arora is an expert, and you have already discussed that in the class. But my limited point is regulatory framework is very crucial. And for instance, in the Fed, they have the Fed wire, so they can, they can track the transactions and all. But on the one side, it leads to the question related to data privacy as well. How much central bank can, Jonathan, if we go for global throttling using the digitized currency, how far central bank can get into the privacy of the use of the digital currency. There are a lot of conflicting questions related to this, but my point is go ahead with the CBDC, central bank digital currency, that is, as a medium of exchange, but store of value, regarding the crypto, because many people, think if they are lucky, if they invest in crypto, if they are lucky, they can, get money. So those kind of aspirations, I think we need to protect rather than banning it altogether, calling it as illicit. But many countries, there is a taxation policy. Using the taxation policy, many countries curb those speculative activities. In the sense, they may charge a very huge taxation to it, but it can also be viewed that the moment a government tax an asset, is it becoming more legitimate and legal? It is not illicit. We can confidently go ahead with crypto. So these are the questions. But I think maybe you also will agree with me, Jonathan, that regulatory framework is more crucial than just saying no and banning those kind of innovations in the field of money and finance. So that's my limited take. Yeah.
Thank you so much, and I concur with your views. I think that it's very important to have a regulatory framework to protect the consumer welfare. But it shouldn't stifle innovation, but it should work together with those innovative technologies and see how we can better serve the public. So this is my view as well. Thank you.
Absolutely. Yeah.
Thank you. Thank you, Jonathan. Okay, any more questions? You can just unmute yourself and speak.
Yeah, Cynthia's question related to sector that's still, it's like what do you call?
Yeah, Cynthia, I'll just, Cynthia, are you able to hear me? Cynthia, is she still there? I'm not sure whether she's still there.
He meant real and financial sector, or?
Yeah, that's what, even I wasn't very clear about it. I don't think she's here right now. Yeah.
Okay.
Anyway, yeah, for some people, actually, the internet keeps on dropping and, dropping in, dropping out like that, yeah. So, yeah, any more questions? Anyone? Those helping out, Ramesh has already inquired. Then, yeah, any more questions? Just simply unmute yourself. Kaleem, you have been helping me out so much. It's your privilege to ask. Just ask anything if you wish. Kaleem? You have been working very hard, Kaleem, so you can just now relax and ask any question, anything, any observation.
Kaleem, license in finance, right?
Yeah.
Okay.
These are all my students, actually. Yeah, so all of them. Some of my PhD students are there as well. Salam. Do you want to raise any question? Ahmed is also there, so he works as central bank for Nigeria. So yeah. Ahmed and Salam, both of you. This topic is very much related to your work.
Nigeria is doing well in the time of just
Yeah.
pure knowledge.
And Nigeria is one country which has actually started the pilot use of CBDC as well. So yeah, so Nigeria is yeah, they have gone ahead actually. Yeah. Yeah. Any questions? Anyone? No. Okay. I don't think anything else is there. Salam Ahmed, still there is chance for you to ask questions. Don't hesitate. Just simply unmute yourself and speak.
What is he researching on?
Salam's topic is on actually conditional cash transfers, social security transfers. Yeah, so very much related to, fiscal monetary space, which we just talked about, and especially during the COVID times. And Ahmed is actually working on environment and economic growth as well. So yeah, so all very much related. Okay.
I always felt that unconditional transfer is better than conditional transfer. Maybe I'm provoking him, but
Salam. Come on, Salam.
Today or
yeah,
later.
exactly.
Yes, please. Actually, I was
Yes.
little bit busy. That's
Okay.
why I could not attend concentrated the whole session. That's why just I don't have
No, don't worry.
much
Yeah, I
important
know.
questions.
Yeah.
But one thing from the very first of 5 or 10 minutes, I have given the concentration. I think this is very good topic in respect of the COVID situation. So my understanding, I think pandemic is not a curse, rather than its blessings in terms of economic perspective. Because I think due to the pandemic situation, we have to think about what sector need to be prioritized. How can we invest our money, and what sector need to be very good, essential to invest in the public finance. And another thing, last you tell me that, Lekha, that I think you tell me that you told that most probably the unconditional cash transfer is better than conditional transfer. But I don't know what is the reason behind it. Can you just please explain a little bit?
Yeah, sure. Thank you so much. Ahmed, let me take your second question first. I believe that conditionality, in the intergovernmental fiscal transfers, if it goes with conditionality, that flexibility of finances at the local level is getting questioned, right? And if you don't the flexibility of finance at the local level, then you may be able to track where you need to spend, but you're getting the money from the higher level of government with the conditionality. So how do you tackle that issue? So that's why. But if it is unconditional, the fiscal autonomy is giving importance, like the fiscal autonomy of the subnational governments to take the decisions. Otherwise, I thought that it's a kind of one-size-fits-all policies. No, that national government sees that we know what is best for you, for the subnational governments, and we design the programs for you, and we give you the menu of list of the programs in which you need to invest. So that was my confusion related to the fiscal autonomy question, and that one-size-fits-all policies can lead to suboptimal outcomes. So these were my limited points. But of course, it's provoking. But you can tell me that why you felt that conditional transfer is crucial. And the first point, I missed it. You had a question, or you were just giving the observations?
Salam?
The observation. I am not sure about this observation that spending.
Which sector to be given the predominance when we talk about public finance principles? Maybe many nations are focused on the capex, but capex that returns can be little long-term in nature. But increasingly, if you unpack the economic stimulus packages, I could see the trend of government money is getting focused on private investment, thinking that it can trigger the private investment, like crowding in of private investment. So that was the predominant narrative. Yeah, infrastructure. Yes.
Okay, thank you very much.
Okay, I think, yeah, so uh, any more questions? Otherwise, we can, Professor Lekha has been, she has been speaking for quite some time, so I'm sure she has answered a lot of questions. And yeah, so any other questions? Final? Okay. So I don't think there are any more questions. And anyway, so thank you so much, Lekha, for coming and for taking time out for this our seminar and for speaking to our students. Thank you so much. And actually, very, very important topic and something which they have already, some of it they have covered, some of it they haven't done it. So yeah, so especially the fiscal policy part of it, they haven't done it. But that, how actually fiscal and monetary policy, how they can deal with various such situations. And they have done actually ISLM model as well. So they know that theoretically like how the two policies can actually help us out in coming out from all these fluctuations, short-term fluctuations. So, yeah, thank you so much, Lekha, and thank you for coming over, and really, and thanks a lot, for all the class people, for all the students, for all the participants, for all my PhD students, and my staff colleagues as well. They had to leave actually because they had some other commitments as well. But thank you for everybody for participating, and a big hand to Professor Lekha from all of us. So yeah.
And all the best to the students. And let it be the beginning. And welcome to write to me in my email. Professor Arora has my email, or even Twitter, or wherever we can catch it. It should be a beginning. And thank you so much for giving me the space, Professor Arora.
Thank you.
Thank you, Lekha, so much.
Thank you.
Thank you.
Thank you very much.
Thank you.
Thank you.